March 10th, 2023. Silicon Valley Bank, the 16th largest bank in America, the darling of tech startups, collapsed in 48 hours. $42 billion withdrawn in a single day. That's $486,000 every single second. By the time I finished this sentence, another million vanished. The speed of sound, 767 miles per hour. The speed of panic, instant. From sound financial condition to bankruptcy, overnight. This is the turkey problem. And over the next 90 minutes, you're going to discover why you are that turkey. Welcome to Trading Psychology Stick, the channel where we talk about the brutal truths that cost traders millions. And just a quick disclaimer, this is not financial advice. Frankly, if you're looking for hot stock tips, you're in the wrong place. This is more like financial therapy, the kind that might hurt a little at first, but could save you from financial ruin. So, if you're ready to face some uncomfortable realities, let's begin. Chapter 1. The Turkey's Last Day. Let me tell you a story that will change how you see markets forever. It comes from Nassim Taleb, a trader turned philosopher who predicted the 2008 crisis when everyone called him crazy. Imagine a turkey. Every day for 1,000 days, a farmer feeds it. Day 1, food arrives. Day 2, food arrives. Day 100, food arrives. Day 500, food arrives. With each passing day, the turkey becomes more convinced of a universal truth. The farmer loves me. Food always comes. Life is predictable. I've figured out the pattern. Day 9999. Food arrives. The turkey is now a statistics expert. It has 999 data points. Confidence is at an all-time high. Day 1000. Food arrives. The turkey thinks, see, I knew it. Tomorrow will be the same. Day 101 is Thanksgiving. Right now, as you're listening to this, you are that turkey and the market. The market is the farmer. Your portfolio, your trading strategy, your risk models, they're all based on the assumption that tomorrow will resemble yesterday. That patterns persist, that what worked will keep working. Silicon Valley Bank thought the same thing. For 40 years, they served tech companies. They survived the dot-com crash. They survived 2008. They had the data. They had the models. They had Nobel Prize-winning risk management. But when interest rates spiked and depositors panicked, their 1,000 days of feeding ended in 48 hours. Here's what's terrifying. This wasn't a failure of intelligence. SVB had the smartest people, the best models, the most sophisticated risk management. It was a failure of imagination. They couldn't imagine what they couldn't imagine. And neither can you. This video isn't about SVB. It's about the black swans circling your portfolio right now. The ones you can't see. The ones your models can't predict. The ones that will turn your 1,000 days of profits into a Thanksgiving massacre. But here's the twist. And this is why you need to watch every minute of what's coming. You don't need to predict black swans to survive them. You need to become anti-fragile to them. Over the next 90 minutes, I'm going to rewire your brain. You'll discover why everything you believe about risk is wrong. Why your losses aren't from bad trades, they're from bad thinking. And most importantly, how to build a system that doesn't just survive black swans. It feeds on them. Let's begin your transformation. Chapter 2. What makes a black swan? Before we go further, you need to understand exactly what a black swan is. Because most people get this wrong, and that misunderstanding is fatal. A black swan has 3 characteristics. Miss even one, and you're not looking at a black swan, you're looking at something else entirely. First, extreme rarity. It's an event so far outside normal expectations that nothing in the past can convincingly point to its possibility. Not just unlikely, not just once in a decade. We're talking about events that break the model itself. Second, extreme impact. When a black swan hits, it doesn't just move markets, it transforms them. It doesn't just cause losses, it rewrites the rules. The impact is so severe that it dominates all the normal fluctuations that came before it. This is the cruelest part. After a black swan occurs, we construct explanations that make it appear predictable. Oh, the signs were there. We should have seen it coming. It was obvious in hindsight. This psychological trick, this need to create a story after the fact, is what keeps us vulnerable to the next one. Now, let me show you what this looks like in reality. The 2023 banking crisis gave us a perfect laboratory. In the span of 5 days, America experienced the second, third, and fourth largest bank failures in its entire history. Silicon Valley Bank, $209 billion in assets, gone. Signature Bank, $110 billion in assets, gone. First Republic, $212 billion in assets, gone. Combined, they held more assets than all the banks that failed in the 2008 financial crisis. Think about that. We had more banking assets fail in 1 week of 2023 than in the entire 2008 meltdown. Was this predictable? Let's see. The week before SVB collapsed, it was rated investment grade by major agencies. Its CEO was on the Federal Reserve's board. Smart money was buying the stock. But here's what was happening beneath the surface, and this is crucial. The entire U.S. banking system was sitting on $620 billion in unrealized losses. $620 billion. These weren't risky derivatives or subprime mortgages. These were safe government bonds that lost value when interest rates rose. The safest assets became the most dangerous. But wait, if we know about these losses, doesn't that make the next crisis predictable? Doesn't that mean it's not a black swan? This is where people get confused. Knowing that risk exists isn't the same as knowing when, how, or where it will explode. We know California will have another major earthquake, but the specific moment when the ground tears apart, that's the black swan. We know there are $620 billion in unrealized losses in the banking system right now. But which bank fails next? When does confidence crack? What triggers the run? That's your black swan, and it's circling overhead as we speak. The 2023 crisis also revealed something even more terrifying: the speed of modern black swans. In 1929, bank runs happened over weeks. People had to physically line up to withdraw money. In 2008, it took days for Bear Stearns to collapse. In 2023, SVB lost $42 billion in deposits in 24 hours, a quarter of its deposits, gone in 1 day. The next black swan won't give you time to react. By the time you recognize it, your portfolio will already be bleeding. But here's what separates the victims from the survivors. Victims try to predict black swans. They build better models. They gather more data. They convince themselves they can see what others miss. Survivors? They build systems that assume black swans are inevitable. They position themselves to benefit from chaos rather than be destroyed by it. Which one are you going to be? Quick question: what's your biggest that could never happen assumption about markets? Drop it in the comments. I bet half of you wrote the same thing. Chapter 3. The Banking Crisis. Nobody saw coming. Let's dive deeper into 2023, because this crisis contains every lesson you need to understand about black swans, and why your brain is wired to miss them. On March 8, 2023, Silicon Valley Bank announced they sold $21 billion of their bond portfolio at a $1.8 billion loss. They needed to raise capital. The tech community, their entire customer base, saw this announcement. What happened next was psychology, not finance. Within hours, venture capitalists started texting their portfolio companies, "Get your money out, now." Panic is a virus, and in 2023, that virus spreads at the speed of Twitter. By the end of March 9th, customers had tried to withdraw $42 billion. That's nearly a quarter of the bank's deposits. The bank had $958 million in negative cash balance. March 10th, California regulators seized the bank. Here's a detail that makes it human. One SVB employee texted his wife, "Don't worry, we're fine," on Thursday. By Friday, he was unemployed. But here's what should terrify you. This wasn't contained to one bank. The research shows that 22 banks experienced runs in March 2023. The panic spread like wildfire through regional banks. Depositors pulled $550 billion from smaller banks in just 2 weeks. Where did the money go? To the too-big-to-fail banks. JP Morgan gained $50 billion in deposits. Bank of America gained $40 billion. The strong got stronger. The weak got slaughtered. Now, you might think, okay, but that's banking. I'm a trader. This doesn't affect me. Wrong. Dead wrong. Let me paint you a picture of how black swans spread. It's called contagion, and it works like this. First, the specific failure. SVB can't meet withdrawals. Then, the category failure. All regional banks become suspect. Then, the asset failure. Bank stocks crash 30% in days. Then, the correlation failure. Everything sells off together. Finally, the system failure. Credit freezes. Margin calls trigger. Correlations go to 1. Your perfectly hedged portfolio, your uncorrelated assets, your stop losses, they all fail at the same time. But the 2023 crisis revealed something even more important, something that will define the next black swan. The failure started in the safest assets, U.S. Treasury bonds, the risk-free rate, the foundation of all financial models. These bonds fell on 20% as interest rates rose. For a bank holding long-term bonds, this was catastrophic. Think about what this means for your portfolio. What's your safe allocation? Bonds, blue-chip stocks, index funds? SVB thought they were being conservative by buying government bonds. They weren't speculating on crypto or meme stocks. They were doing what every risk model recommended, buying the safest assets in the world, and it killed them. Here's the data that should keep you up at night. Right now, today, the U.S. banking system still has over $600 billion in unrealized losses. Commercial real estate has $500 billion in loans coming due. Office buildings sit empty. Regional banks hold 18% of their assets in commercial real estate. The ingredients for the next black swan are already in the pot. The only question is when someone lights the match. But remember what I said. You don't need to predict when. You need to be positioned for IF. And that positioning starts in your mind. Because the biggest risk isn't in the market, it's in your mirror. Chapter 4. Your Brain on Black Swans. This is where we separate the professionals from the amateurs. Not by looking at your returns or your experience, but by understanding how your brain betrays you. Let me introduce you to the most expensive piece of software you'll ever use, your mind. Daniel Kahneman, a psychologist who won the Nobel Prize in economics, discovered something that explains why smart people make catastrophic financial decisions. Your brain runs 2 operating systems. System 1, fast, automatic, intuitive, emotional. System 2, slow, deliberate, logical, effortful. Here's the problem. Trading happens in System 1. Risk management requires System 2. When SVB announced their loss, depositors' System 1 kicked in. Danger! Withdraw now! No analysis, no math, just pure primal panic. And here's what's fascinating. They were right to panic. System 1 saved them. But for every time System 1 saves you, it destroys you 10 times over. You see a stock dropping. System 1 screams, sell before it gets worse. You see a stock rising. System 1 whispers, buy before you miss out. You see others making money. System 1 shouts, you're falling behind. Sound familiar? System 1 is fast because it uses shortcuts, mental shortcuts called heuristics. These shortcuts helped our ancestors survive on the savannah. But in markets, they're deadly. Here's the shortcut that killed SVB's depositors' confidence. Bank needs capital equals bank is failing equals get out now. Simple, fast, wrong, until it was right. The panic created the very failure it feared, a self-fulfilling prophecy powered by System 1 thinking. Now, you might think, I'm smarter than that. I use analysis. I have a system. Really? Let me ask you something. When was the last time you held a losing position too long because you knew it would come back? When was the last time you increased position size after a winning streak? When was the last time you ignored your stop loss because this time was different? That wasn't stupidity. That was System 1 hijacking your brain. But here's where it gets really interesting. Researchers put traders in brain scanners while they made decisions. Know what they found? The same regions that light up during cocaine use light up during profitable trades. Your brain literally gets high on making money. And just like any addict, you'll do increasingly dangerous things to get your next hit. This is why leverage kills. Not because the math is hard, because your brain is compromised. Bill Huang at Archegos, brilliant investor, built $36 billion from $200 million. But leverage turned his System 1 into a weapon of mass destruction. When you're leveraged 5-to-1, every tick triggers fight or flight. System 2 shuts down. You're not trading anymore. You're surviving. And survival mode makes you do stupid things, like double down instead of cut losses, like hide risk from yourself and others, like believe your own lies about temporary setbacks. But the cruelest trick your brain plays, It happens after a black swan. It's called hindsight bias, and it works like this. After SVB collapsed, everyone said, obviously, rising rates kill bond values. How did they not see it? After Archegos imploded, of course, that much leverage always ends badly. After 2008, subprime was always going to blow up. Your brain rewrites history to make the unpredictable seem predictable. This isn't just annoying, it's dangerous. Because if you believe you could have seen it coming, you believe you'll see the next one coming. You won't. So, how do you fight a brain that's wired to fail? First, accept that you will be fooled. Your system 1 will hijack you. You will make emotional decisions. Accepting this isn't weakness, it's the beginning of strength. Second, build systems that protect you from yourself. Rules that engage System 2 before System 1 takes over. Position sizing rules, stop losses, time limits, cooling off periods. These aren't just risk management, they're brain management. Third, study your own failures. Not to beat yourself up, but to map your mental weaknesses. When do you break rules? After wins or losses? What triggers your FOMO? Specific setups? Other traders' success? Where does your overconfidence live? In familiar stocks? In trending markets? Know your enemy, and your enemy is in the mirror. Because here's the truth. The market doesn't beat you. You beat yourself. The market just collects the bill. Chapter 5. The Narrative Fallacy Trap. Now I'm going to show you the most expensive story ever told. It cost $36 billion and destroyed one of the most successful traders you've never heard of. His name was Bill Hwang, and his story will teach you why the tales we tell ourselves are more dangerous than any market move. Pause for 10 seconds. Write down the story you're telling yourself about your current biggest position. Go ahead, I'll wait. Now add these words. And this might be complete BS. How does that feel? In March 2020, as COVID crashed markets, Hwang saw opportunity. He started with $200 million of his own money. By March 2021, he controlled $36 billion. That's a 180-fold increase in 1 year. How? He told himself a story. The story went like this. Media companies are undervalued. Streaming is the future. I see what others don't. I just need to concentrate my positions and use leverage to maximize the opportunity. Simple story, compelling story, expensive story. Hwang didn't just buy stocks. He used something called total return swaps, derivatives that let him control massive positions without actually owning the shares. He built positions so large that he secretly controlled over 50% of Viacom CBS shares. 50%. The banks lending him money didn't even know how concentrated he was because he used multiple banks. Each bank thought they were his primary lender. None knew about the others. On March 22, 2021, Viacom CBS announced a stock offering. Normal corporate action. Happens every day. The stock dropped 9%. For most investors, a 9% drop is painful but manageable. For someone leveraged 5 to 1, it's catastrophic. Hwang got margin calls. He needed billions in cash, immediately. March 26th, the banks started liquidating his positions. In 48 hours, Archegos evaporated. 36 billion to zero. The banks lost 10 billion. Credit Suisse alone lost 5.5 billion. But here's what really happened. Hwang wasn't defeated by markets. He was defeated by his story. The story made him ignore diversification. Why diversify when you know you're right? The story justified leverage. This opportunity won't last. I need to maximize it now. The story dismissed risk. Temporary volatility doesn't matter when you see the big picture. Every dangerous decision made perfect sense within his narrative. This is the narrative fallacy. Your brain's desperate need to create cause and effect stories that explain the chaos around you. We can't help it. Our brains are story-making machines. Market goes up, Fed stimulus is working. Market goes down, inflation fears are rising, your stock crashes, manipulation by hedge funds. Always a story, always an explanation, always wrong. Why wrong? Because markets are complex systems with billions of variables interacting in non-linear ways. But your brain can't process that. So it creates simple stories with clear villains and heroes. These stories feel true. They feel insightful. They feel like wisdom. They're not. They're comfort food for confused minds. Let me show you how this works in real time. Right now, what's your story about why you're watching this video? Maybe, I'm smart enough to learn from others' mistakes. Or, I'm building knowledge to become a better trader. Or, I'm different from the average retail trader who loses money. Feel good, make sense, give you confidence, that's the trap. Because while you're telling yourself stories about learning and growing, your brain is also telling you other stories. That won't happen to me because my situation is different because I would never make that mistake because every trader who ever blew up told themselves the same stories. The solution isn't to stop telling stories. You can't. Your brain won't let you. The solution is to recognize stories, not as truth. When you find yourself explaining a loss, catch yourself. That's a story. When you justify increasing position size, pause. That's a story. When you feel certain about a trade's outcome, stop. That's a story. The most dangerous sentence in investing starts with, "It's different this time because..." No, it's not different. It's never different. The only thing that changes is the story we tell about why it's different. Huang told himself a story about media transformation. SVB told themselves a story about interest rate stability. LTCM told themselves a story about market efficiency. What story are you telling yourself? Here's an exercise that might save your portfolio. Write down your current market thesis, your edge, your strategy, why you're going to succeed. Now add this sentence to the end, and this is just a story I'm telling myself. Feel uncomfortable? Good. That discomfort is the beginning of wisdom. Because the market doesn't care about your story. It doesn't care about your analysis. It doesn't care about your conviction. The market is a story-shredding machine, and it's really, really good at its job. Want to survive? Stop being the author. Start being the editor. Cut every subplot that involves predicting the future. Delete every chapter about certainty. Rewrite your role from hero to student. Most importantly, never ever fall in love with your own narrative. Because in markets, the best story wins. And the best story is usually, I don't know what happens next, so I'm prepared for anything. That's not a story that sells books or gets YouTube views, but it's the only story that keeps you alive when black swans come hunting. Chapter 6, Overconfidence, the Silent Killer. I need to tell you about the most dangerous moment in your trading career. It's not when you're losing, it's when you're winning. Let me show you why. Bill Huang didn't start with 5-to-1 leverage. He started conservatively, made money, increased size, made more money, increased leverage, made even more money. Each success fed his confidence. Each win proved his thesis. Each profit validated his approach. By the time he reached dangerous leverage levels, he wasn't a risk taker in his own mind. He was a proven winner, simply maximizing a sure thing. This is how overconfidence kills. Not suddenly, but gradually. Not obviously, but subtly. I'll admit it, I once lost $50,000 because I knew oil couldn't go negative. Then April 2020 happened. The lesson? Markets don't care what you know. There's a brutal truth about trading that nobody wants to hear. The better you get, the more dangerous you become. Why? Because expertise breeds confidence, and confidence unchecked breeds overconfidence. Researchers studied thousands of traders. Know what they found? The traders who were most confident in their abilities traded 45% more often than less confident traders. Their returns, 7% lower annually. The more confident they were, the worse they performed. But here's where it gets really twisted. Overconfidence isn't equally distributed. It clusters around specific situations. After winning streaks, confidence soars. In familiar markets, confidence peaks. With leverage available, confidence explodes. Sound like 2021, when everyone was a genius, when shoeshine boys gave stock tips, when your Uber driver talked about options. That wasn't wisdom. That was an overconfidence epidemic. And epidemics always end the same way. Let me tell you what overconfidence looks like in practice. I've been trading this stock for years. I know how it moves. Translation: I'm pattern matching random noise. My system has been profitable for 6 months straight. Translation: I've been lucky in a trending market. I can feel when the market's about to turn. Translation: I'm confusing hindsight with foresight. Every one of these statements feels true to the person saying it. That's what makes overconfidence so insidious. It doesn't feel like arrogance. It feels like earned wisdom. The numbers tell the real story. 90% of traders think they're above average, mathematically impossible. 80% of drivers think they're better than average. Statistically absurd. 100% of blown-up traders thought they were different. Universally wrong. This isn't stupidity. It's human nature. We're wired to overestimate our abilities and underestimate our risks. In normal life, this keeps us motivated. In trading, it keeps us poor. But the deadliest form of overconfidence, it comes from education. The more you learn about markets, the more you think you understand them. But markets aren't puzzles to be solved. They're complex adaptive systems that evolve faster than your understanding. LTCM had 2 Nobel Prize winners, PhDs from MIT, the smartest financial minds on the planet. They built models so sophisticated that they needed supercomputers to run them. They back-tested everything. They had 40-to-1 leverage because their models proved it was safe. In 1998, Russia defaulted on its debt, an event their models said was virtually impossible. LTCM lost $4.6 billion in 4 months. They needed a Federal Reserve orchestrated bailout to prevent systemic collapse. The smartest guys in the room, destroyed by overconfidence. So, how do you fight an enemy that feels like a friend? First, measure everything. Your feelings lie, numbers don't. Track your predictions, all of them. You'll be shocked how wrong you are, how often. Track your win rate by position size. I guarantee you'll find you're more aggressive when you're more confident and less profitable. Track your performance after winning streaks. This is when overconfidence peaks and returns plummet. Second, institutionalize humility. Before every trade, write one reason it could fail. After every win, write what role luck played. After every loss, write what warning signs you ignored. This isn't negative thinking. It's realistic thinking. Third, respect the paradox. The more certain you feel, the more careful you should be. The better your returns, the more you should reduce size. The more experience you have, the more you should question yourself. This feels backwards because it is backwards. But backwards to human nature is often forwards to survival. Here's the truth that took me years to understand. Confidence is about knowing what you know. Wisdom is about knowing what you don't know. In markets, wisdom pays better. The moment you think you figured it out, that's the moment the market teaches you that you haven't. Stay humble, or the market will humble you. And the market's lessons are much more expensive than mine. Chapter 7. The Cemetery You Can't See. I'm about to show you something that will fundamentally change how you see every success story, every trading guru, every system that always works. It's called the silent evidence, and it's hiding the most important information you need to survive. If failed traders had tombstones, Manhattan would be a graveyard. Here lies Mike. He fought the Fed. R.I.P. Sarah. She averaged down. Dave's final trade. All in on margin. Dark humor? Maybe. But it illustrates a crucial point. Imagine a cemetery, but not a normal cemetery. This one is filled with the dreams of dead traders, failed strategies, blown accounts, abandoned systems. For every trader you see on YouTube celebrating gains, there are thousands in this cemetery. For every strategy that beats the market, hundreds are buried here. For every fund that survives 10 years, dozens are decomposing in this ground. You never see this cemetery, but it's bigger than every trading forum, every success story, every course combined. This is survivorship bias, and it's lying to you every single day. Let me show you how this deception works. You study successful traders, you read their books, you copy their strategies, you follow their rules. But you're only studying the survivors, the lucky ones, the statistical outliers. What about the traders who used the exact same strategies and failed? They're in the cemetery, silent, invisible, teaching you nothing. But their lessons are more valuable than any winner's biography. Here's a thought experiment that will disturb you. Take 10,000 coin flippers. Each flips a coin 10 times, betting their account on each flip. Heads, they double their money. Tails, they lose everything. After 10 flips, statistically, about 10 people will have won every single flip. They'll have turned $1,000 into $24,000. These 10 will write books, The Art of Coin Flipping. They'll start YouTube channels, How I Made $1 Million Flipping Coins. They'll sell courses, my proprietary coin analysis system. They'll analyze their technique, their mindset, their preparation, their edge. It's all nonsense. They're just the random survivors. The 1990 who lost everything, they're in the cemetery, silent. Now, here's the kicker. The market is worse than coin flipping. At least with coins, you know it's random. In markets, randomness wears the disguise of pattern. Luck masquerades as skill. Coincidence pretends to be strategy. This creates a perfect storm of deception. Survivors attribute success to skill, not luck. Observers see patterns in random outcomes. Everyone ignores the cemetery. Bill Hwang, before he lost $36 billion, he turned $200 million into $15 billion at his previous fund. He was a legend, a genius, a case study in concentrated conviction. Then he joined the cemetery, but for every Bill Hwang who made headlines when he failed, thousands disappear quietly. A retail trader in Ohio who lost his retirement. A fund manager in London who shut down after 2 bad years. A day trader in Tokyo who gave up after losing 90%. Their stories matter more than the winners, but you'll never hear them. This bias infects everything. Those trading forums where everyone posts gains, the losers stopped posting. That strategy with 5-star reviews, the 1-star reviewers deleted their accounts. That mentor bragging about student success, the failures don't get testimonials. You're seeing a carefully curated highlight reel of randomness dressed up as skill. But it gets worse. Your own memory has survivorship bias. You remember your winning trades vividly. The losses, they fade. You remember when your analysis was right. When it was wrong, you forget. You remember the rules that worked, the ones that didn't. They disappear. Your brain is literally editing your history to make you feel more skilled than you are. Combine external survivorship bias with internal memory bias, and you get a dangerous delusion. That success is more common, more predictable, and more controllable than it actually is. So, how do you fight an invisible enemy? First, study failures more than successes. For every winner's biography, read about a spectacular blow-up. For every profitable strategy, find traders who lost money using it. For every guru's system, find students who failed. The cemetery teaches what the podium can't. Second, assume you're average until proven otherwise. If 90% of traders lose money, assume you're in the 90%. If most strategies fail, assume yours will too. If leverage usually kills, assume it will kill you. This isn't pessimism. It's mathematics. Third, track the graveyard, not just the garden. Keep a journal of failed trades, abandoned strategies, and broken rules. Study them, learn from them, honor them. They're not failures. They're expensive education. Here's the brutal truth. Right now, thousands of traders are using your exact strategy. Most will end up in the cemetery. If your answer is about your analysis, your discipline, or your edge, congratulations. That's exactly what everyone in the cemetery thought. The only answer that might save you is, nothing makes me different. That's why I prepare for failure, not success. Because in trading, the cemetery is always bigger than the celebration. And if you can't see the graves, you're probably digging your own. Pause and reflect. Stop. Before we continue, I need you to do something. Not later, not after the video, right now. Ask yourself, when was your personal turkey moment? That time when you were absolutely certain. And then the market reminded you that certainty is an illusion. Maybe it was an earnings play that went wrong. Maybe it was a safe blue chip that crashed. Maybe it was an entire strategy that suddenly stopped working. Feel that knot in your stomach? That memory you've been trying to forget? Good. That's not failure. That's data. Every trader has turkey moments. The winners learn from them. The losers repeat them. Which one are you going to be? Take 10 seconds. Close your eyes. Remember that moment. Feel it. Now open your eyes. That feeling you just experienced, that mixture of regret, embarrassment, and pain. That's what protecting yourself from black swans is really about. Not preventing all losses, preventing the ones that force you to start over. Let's continue. Chapter 8. Mediocristan versus Extremistan. Now I'm going to teach you the most important distinction in risk management. Miss this, and nothing else matters. It's the difference between mediocristan and extremistan, and once you see it, you can't unsee it. If you're still thinking this won't happen to me, type turkey in the comments. At least be honest about it. Let me make this real. My cousin Sarah is a teacher, makes $50,000 a year. Her big raise, 3%. That's mediocristan. Her neighbor bought Bitcoin at $100, now worth $6 million. That's extremistan. Same neighborhood, same time frame, different universe. Imagine you're in a stadium with 10,000 people. You want to guess the average height. You sample 100 people randomly, Maybe the average is 5 feet 9 inches. Now sample another 100. Maybe 5 feet 8 inches. Another 100. Maybe 5 feet 10 inches. The averages are all close. Why? Because in height, no single observation can wreck your average. Even if LeBron James walks in at 6 feet 9 inches, he barely moves the needle. This is mediocristan, the realm of the normal distribution, the bell curve, where outliers don't matter much. Now let's talk wealth. Same stadium. 10,000 people. You sample 100 people. Average net worth, $100,000. Sample another 100. Average, $90,000. Another 100. Average, $110,000. Seems stable, right? Then Jeff Bezos walks in. The average net worth is now $20 billion. One person changed everything. This is extremistan, the realm of power laws, wild distributions, where outliers dominate everything. Here's why this matters for your survival. Markets are extremistan, but your brain thinks they're mediocristan. Your brain evolved in mediocristan. For millions of years, our ancestors dealt with mediocristan problems. How tall is that tree? How fast is that predator? How much food do I need? All mediocristan. All normal distributions. All predictable within ranges. But markets? Pure extremistan. One announcement can move a stock 50%. One fund liquidating can crash a sector. One tweet can create or destroy billions. This creates a fatal mismatch. Your intuition is calibrated for mediocristan. Your risk models assume mediocristan. Your position sizing expects mediocristan. But you're swimming in extremistan. It's like using a map of Kansas to navigate the Himalayas. The tools don't match the terrain. Let me show you how deadly this mismatch is. In mediocristan, you can safely average down. If something is below average, it'll probably revert. In extremistan, averaging down is suicide. Things can go to zero. In mediocristan, diversification works. Spread your bets, reduce your risk. In extremistan, correlation goes to 1 in a crisis. Everything crashes together. In mediocristan, past data predicts future outcomes. In extremistan, the most important events have never happened before. Value-at-risk models, the ones banks use, assume mediocristan. They calculate the worst loss you should expect 95% or 99% of the time. But in extremistan, it's the other 1% that kills you. LTCM's models said their losses were a 10 sigma event, should happen once in the lifetime of several universes. SVB's interest rate risk was manageable according to every standard model. Archegos' leverage was appropriate for their volatility assumptions. All mediocristan thinking in an extremistan world. So, how do you survive in extremistan? First, throw away the bell curve. It's not just wrong, it's dangerously wrong. Your risk isn't distributed normally. It's concentrated in the tails, the rare events, the impossibilities that happen every few years. Second, plan for the impossible. In mediocristan, you plan for what's probable. In extremistan, you plan for what's possible. Can this stock go to zero? Then position like it might. Can this correlation break? Then don't rely on it. Can this safe asset crash? Then it's not safe. Third, respect the turkey problem. In mediocristan, 1,000 days of data means something. In extremistan, 1,000 saved days might just mean day 1001 is Thanksgiving. Here's a simple test. Look at your biggest position right now. What would happen if it went to zero tomorrow? If your answer is that's impossible, you're thinking mediocristan. If your answer is I'd be hurt but I'd survive, you're thinking extremistan. One mindset builds wealth slowly, the other loses it quickly. The market is extremistan, always has been, always will be. The only question is, are you positioned for the world you wish existed or the one that actually does? Because in extremistan, the difference between those two is everything. Chapter 9. The Ludic Fallacy. Let me tell you about the most expensive mistake in human thinking. It's called the Ludic Fallacy, and it's probably in your trading plan right now. Ludic comes from the Latin word for game, and this fallacy is believing that markets work like games. In a casino, the rules are fixed. A roulette wheel has 38 slots. The odds never change. The house edge is mathematical and constant. You can calculate risk perfectly because the game never changes. This is closed system randomness, contained, controlled, predictable within its parameters. Now, Let me tell you what markets are really like. Imagine playing poker where the rules change mid-hand, where new cards get added to the deck without warning, where the dealer might suddenly decide flushes beat full houses, where the table might flip over because someone in another room pressed a button. That's open system randomness, wild, uncontrolled, unpredictable even in theory. But here's where it gets dangerous. Every risk model you've ever seen treats markets like casinos. They assume the rules are stable. The distributions are known, the parameters are fixed. Value at risk assumes casino randomness, modern portfolio theory, casino randomness. The Greeks in options, casino randomness. Your backtesting, casino randomness. We've built an entire financial system on the fantasy that markets are a really complex casino. They're not. LTCM, long-term capital management, was the ultimate expression of the ludic fallacy. Two Nobel Prize winners, Myron Scholes and Robert Merton. They literally invented the formulas the entire derivatives market uses. They built models so sophisticated they could find tiny price discrepancies between related bonds. Their strategy was simple: bet on convergence. When prices diverge from historical relationships, bet they'll converge. In a casino, this works perfectly. In markets, it works, until it doesn't. For 4 years, LTCM printed money. Returns of 40% annually. They were so confident, they leveraged up to 40 to 1. Their models showed this was safe. The relationships they traded had never broken beyond certain bounds. Decades of data confirmed it. Then Russia defaulted on its debt in 1998. Suddenly, everything that was supposed to converge diverged. Everything that was supposed to be correlated wasn't. Everything that was supposed to be liquid froze. The models didn't just fail, they failed in the opposite direction. The very bets that were supposed to hedge each other all lost money simultaneously. 4 months, $4.6 billion, gone. The smartest people in finance, destroyed by assuming markets were a game with rules. But you do this too, every day. When you backtest a strategy, you're assuming the past is a good guide to the future. Ludic fallacy. When you calculate risk-reward, you're assuming the parameters are stable. Ludic fallacy. When you size positions based on historical volatility, you're assuming volatility clusters predictably. Ludic fallacy. The market isn't a game. It's a living ecosystem that evolves, adapts, and occasionally has psychotic breaks. Here's what really happened to SVB through the lens of the ludic fallacy. For 40 years, interest rates generally went down. Bond prices generally went up. This wasn't a rule, it was just what happened. SVB built their entire balance sheet assuming this pattern would continue. They bought long-term bonds yielding 1.5% when deposits were free. Then the game changed. Rates rose faster than any time in 40 years. Those safe bonds lost 20% of their value. SVB was playing by the old rules in a new game. The casino had transformed into a war zone, but they were still counting cards. So, how do you escape the ludic fallacy? First, add a question to every trade. What if the rules change? Not the prices, the rules. What if correlations invert? What if liquidity vanishes? What if the thing that never happens, happens? Second, distinguish between risk and uncertainty. Risk is when you don't know what will happen, but you know the odds. That's casino randomness. Uncertainty is when you don't know what will happen and you don't know the odds. That's market randomness. You can manage risk. You can only survive uncertainty. Third, build strategies that don't require stable rules. In a casino, you can card count because the deck is fixed. In markets, you need strategies that work even when someone adds new cards, changes the values, or sets the table on fire. Here's the test. If your strategy needs historical relationships to hold, it's fragile. If it needs correlations to stay stable, it's fragile. If it needs the game to keep its rules, it's fragile. The market isn't just playing a different game than you think. It's playing a game where changing the game is the game. Winners aren't the ones who master the rules. Winners are the ones who survive when the rules explode. Because in markets, the house doesn't always win. Sometimes the house burns down. Sometimes the dealer goes insane. Sometimes the cards catch fire. That's not a bug in the system. That's the system. Plan accordingly. Chapter 10. From fragile to anti-fragile. Everything you own, every strategy you run, every position you hold falls into one of 3 categories. Know which one or die poor. These aren't my categories. They come from Nassim Taleb, the trader philosopher who saw 2008 coming and profited from it. You know what? Let's take a breath. You've absorbed a lot. Your brain is probably fighting some of these ideas. That's normal. That's healthy. That's your system one, protecting old beliefs. Here's a funny thing. Every successful trader I know had the same reaction first time they heard this. This is too extreme, too paranoid, too conservative. 5 years later, they're all running barbells. Funny how survival changes your perspective. Now, let's talk about the 3 categories that will save your life. Category 1, fragile. These things break under stress. Volatility hurts them. Uncertainty destroys them. Time decay kills them. A leveraged position is fragile. A concentrated portfolio is fragile. A strategy that needs specific conditions is fragile. SVB was fragile. One shock, rising rates, shattered them. Archegos was fragile. One reversal, Viacom CBS dropping, annihilated them. Category 2, robust. These things resist stress. Volatility doesn't affect them much. Uncertainty bounces off them. Time doesn't erode them. A diversified portfolio is robust. A cash position is robust. A business with multiple revenue streams is robust. But here's the key. Robust things don't break under stress, but they don't improve either. They just endure. Category 3, anti-fragile. This is where the magic happens. Anti-fragile things don't just survive stress. They need it. They feed on it. They get stronger from it. Your muscles are anti-fragile. Stress them, they grow. Your immune system is anti-fragile. Expose it to pathogens, it strengthens. But can a portfolio be anti-fragile? Can a trading strategy actually benefit from chaos? Yes. And once you understand how, you'll never see markets the same way. Here's the secret. Anti-fragility comes from optionality. When you have more upside than downside from random events, you're anti-fragile. Think about it. A call option is anti-fragile to upward moves. You can only lose your premium, but gains are unlimited. A venture capital portfolio is anti-fragile. Most investments go to zero, but one Facebook pays for 1,000 failures. A barbell strategy is anti-fragile. Most of your money is super safe. A small portion is super risky. Chaos can only help you. But here's where people get confused. They think anti-fragile means predicting volatility or timing the market. No. Anti-fragile means you don't know what will happen, but you're positioned to benefit from whatever does. You're not betting on chaos. You're structured to exploit it when it arrives, because chaos always arrives. Let me make this concrete. Fragile. You have $100,000 in one tech stock with 2-to-1 leverage. Any shock kills you. Robust. You have $100,000 spread across 50 stocks. Shocks don't help or hurt much. Anti-fragile. You have $90,000 in treasury bills and $10,000 in far out-of-the-money options on volatility. Normal markets. You lose a little on the options, make a little on bonds. Barely notice. Chaos hits. Your options go 10x, 20x, maybe 50x. You're hoping for a black swan. See the difference? Now, here's the mindset shift that changes everything. Fragile people fear black swans. They buy insurance, they hedge, they pray for stability. Robust people ignore black swans. They diversify, they endure, they wait out storms. Anti-fragile people hunt black swans. They position for them, they profit from them, they need them. Which one are you? Here's how to build anti-fragility. First, eliminate fragility. Cut leverage. Reduce concentration. Remove anything that can blow you up. You can't be anti-fragile if you're dead. Second, secure your base. Put most of your capital where it can't be hurt. This isn't exciting. It's not supposed to be. It's supposed to keep you alive. Third, add convex bets. Small positions with limited downside and unlimited upside. Options, crypto moonshots, biotech lottos. Anything where you can lose 1x but gain 100x. Fourth, reframe volatility. Stop seeing it as danger. Start seeing it as opportunity. Every crash is a chance to buy cheap. Every spike is a chance to sell expensive. Every shock is a chance to restructure better. But here's the most important part. Anti-fragility isn't just about portfolios. It's about psychology. A fragile mindset breaks under losses. An anti-fragile mindset learns from them. A fragile ego needs to be right. An anti-fragile ego needs to survive. A fragile trader fears being wrong. An anti-fragile trader fears being fragile. Right now, look at your largest position. Ask yourself, if chaos hits tomorrow, will this position break, endure, or thrive? If the answer isn't thrive, you're playing defense in a game that rewards offense. Because here's the final truth. In a world of black swans, fragility is guaranteed death. Robustness is slow death. And only anti-fragility is life. The market isn't trying to beat you, it's trying to teach you. The lesson? Stop trying to predict the storm. Start building a ship that gets stronger in rough waters. That's not just smart trading, that's evolution. Chapter 11. The Barbell Strategy. Taleb discovered something that made him millions while others lost everything. 3 categories that determine your survival. Miss this distinction, and nothing else we've covered matters. I'm going to show you the only portfolio construction method designed for a world where prediction is impossible and black swans are inevitable. It's called the Barbell Strategy, and it's the opposite of everything you've been taught. March 2020. My friend Jake had a balanced portfolio. 60-40 stocks and bonds. Lost 28% in 3 weeks. Panicked. Sold everything at the bottom. His neighbor? Weird guy. 90% in T-bills, 10% in VIX calls. Made 400% on the calls. Bought stocks at the bottom with profits. One played it safe. One played it smart. Guess who retired early? Forget the 60-40 portfolio. Forget balanced allocation. Forget moderate risk for moderate reward. That's mediocrist thinking. We need extremistan solutions. Here's the barbell. Put 90% of your capital in the safest possible assets. Put 10% in the riskiest possible bets. Nothing in the middle, nothing. Why? Because medium risk is a lie. That balanced portfolio of blue chip stocks, that's not medium risk. That's hidden fragility. One systemic shock and everything correlates to 1. Those conservative corporate bonds, ask SVB how conservative they were when rates spiked. That diversified index fund, in March 2020, diversification meant losing 35% in 3 weeks. The middle is where black swans feast, but a barbell is anti-fragile. Side 1, 90% in true safety. Not relatively safe, not investment grade, true safety. Treasury bills, not bonds, bills. Short-term, no duration risk, physical cash, not bank deposits, cash. No counterparty risk, maybe some gold, physical metal, not ETFs. This side can't blow up, not won't, can't. Side 2, 10% in lottery tickets. And I mean that literally, far out of the money options. Cryptocurrency moonshots, biotech binary events. Anything with 10 to 1, 50 to 1, 100 to 1 potential. This side will blow up. Frequently, that's the point. Here's the magic. Normal markets. You make almost nothing on the safe side. You lose most of the risky side. Net result, small loss. Who cares? Black swan hits. Safe side untouched. Risky side explodes. One position goes 50x and pays for 5 years of small losses. You're not predicting the black swan. You're just positioned to catch it if it flies by. Let me show you this in action. March 2020. COVID crashes markets. Traditional portfolio. Down 30 to 40%. Scrambling, panicking, selling the bottom. Barbell portfolio. Safe side untouched. But those crazy puts you bought for 50 cents, now worth $25. Your VIX calls, up 1,000%. You're not surviving the crisis. You're profiting from it. But here's where people screw this up. They put 90% in safe stocks. Wrong. Stocks are never safe. Ask GE shareholders. Ask bank shareholders. Ask anyone who thought blue chips couldn't fail. They put 10% in risky stocks. Wrong. Stocks aren't risky enough. You need convexity, asymmetry, explosion potential. They can't handle the boredom. This is the real killer. A proper barbell is boring 95% of the time. You make nothing. You trail the market. You look stupid. Your brother-in-law is getting rich on Tesla. Your neighbor is killing it in crypto. Your coworker just made 50% on some SPAC. And you're sitting there with treasury bills and lottery tickets, looking like an idiot until you don't. Taleb ran a barbell for years, lost small amounts, looked foolish, trailed every index. Then 2008 hit. While banks collapsed and portfolios evaporated, Taleb's fund returned 115%. 1 year, one black swan. Career made. Here's how to build your own barbell. Step 1. Calculate your true risk capital, not what you can afford to lose. What you can lose without changing your lifestyle at all. Step 2. Take everything else, everything, and put it in maximum safety. Ignore yields. Ignore opportunity cost. This money has one job: survive. Step 3. Take that risk capital and swing for the fences, but not with stocks, with instruments that have convex payoffs. Options that cost 10 cents and could go to $10. Cryptocurrencies so small they're not on major exchanges. Biotech companies with one drug in trials. Step 4. Rebalance religiously. When a lottery ticket hits, move profits to the safe side. When they expire worthless, replace them. Step 5. Embrace the boredom. You're not trying to beat the market every year. You're trying to survive everything and thrive on chaos. But here's the psychological challenge. The barbell requires you to accept two things most traders can't. You will underperform in bull markets. Guaranteed. You will look stupid most of the time. Guaranteed. But you'll also sleep peacefully. You'll never face ruin. And when the world burns, you'll be shopping for bargains with your lottery ticket winnings. Ask yourself, what's your current allocation? If you have more than 10% in the middle risk zone, you're not barbelled. You're exposed. If your safe assets can lose more than 5% in any scenario, they're not safe. They're pretending. If your risky bets can't go 10x or more, they're not risky enough. They're just bad investments. The barbell isn't a strategy. It's a philosophy. Accept that you can't predict. Position so you don't need to. Wait for reality to deliver gifts. It's not exciting. It's not impressive. It's not what anyone else is doing. That's precisely why it works. Chapter 12. Position sizing, the lifesaver. Here's a challenge. Calculate 2% of your account right now. Put that number in the comments. That's your new maximum loss per trade. Full stop. I'm about to teach you the most important formula in trading. It's not technical analysis. It's not fundamental analysis. It's simpler and more powerful than both. It's the answer to how much. Get this wrong, and nothing else matters. You can pick perfect entries, time exact tops and bottoms, have inside information, and still go broke. Because position sizing determines who survives and who dies. Let me tell you about two traders, same strategy, same trades, same market. Trader A risks 2% per trade. Trader B risks 10% per trade. After 10 losses in a row, which will happen, Trader A is down 18%. Annoying but manageable. Trader B down 65%. Game over. Same trades, different position sizing. One survives, one dies. Now here's where it gets interesting. There's a formula called the Kelly criterion. It tells you the optimal bet size for maximum growth. Casinos fear it. Mathematicians love it. And it will destroy you in markets. Why? Because Kelly assumes you know your edge, your exact win rate, your exact payoff ratio. In blackjack, you can know these things. In markets, you're guessing. And when you guess wrong with Kelly, you don't just underperform, you go broke. Ed Thorpe, the math professor who beat Vegas and then Wall Street, used Kelly. But here's what most people don't know. He used fractional Kelly, half Kelly, quarter Kelly, sometimes 1/10 Kelly. Why? Because he understood the difference between theory and reality. In theory, Kelly maximizes growth. In reality, Kelly maximizes the chance you'll quit before you get rich. Let me show you what this means with real numbers. Say your system wins 60% of the time with 1-to-1 payoff. Kelly says bet 20% of your account. Sounds reasonable? Here's the problem. With 20% bets, you have a 50% chance of a 50% drawdown before doubling your money, half your account, gone. Temporarily, but psychologically, that's death. Now, use quarter Kelly, 5% bets. Your chance of that same drawdown drops to less than 1%. You'll grow slower, but you'll actually get there. Archegos used 5-to-1 leverage. That's not position sizing. That's position suicide. When you leverage, you're not just amplifying returns. You're amplifying the chance of ruin. And ruin doesn't care about your thesis. Ruin doesn't care about your edge. Ruin is mathematical, not emotional. Here's the formula. Risk of ruin equals 1 minus edge, divided by 1 plus edge, raised to the power of capital divided by risk per trade. Leverage shrinks your capital relative to risk. Your risk of ruin explodes exponentially. Bill Hwang didn't fail because he was wrong about media stocks. He failed because his position sizing guaranteed eventual destruction. So here's your survival guide. Rule 1. Never risk more than 1 to 2% per trade. Never. But that's so small. Yes, that's the point. You're not trying to get rich on one trade. You're trying to survive long enough for your edge to manifest. Rule 2. Cut position size after losses. Lost 10%. Cut size by 20%. Lost 20%. Cut size by 50%. This isn't admitting defeat. It's preserving ammunition. Rule 3. Position size based on volatility, not conviction. Your confidence is irrelevant. The market's volatility is everything. Use ATR. Use standard deviation. Use anything but your feelings. Rule 4. When in doubt, go smaller. The trades you're most confident about are often your biggest losses. Confidence and position size should be inversely correlated. But here's the master key. Position sizing isn't really about math. It's about psychology. Small positions let you think clearly. Large positions hijack your brain. Small losses let you come back tomorrow. Large losses make you do stupid things today. Small bets let you play long enough to win. Large bets guarantee you'll quit before you do. Right now, calculate. What's 2% of your account? That number, that exact number, is your maximum loss per trade, not your position size, your maximum loss. Stock could go to 0. Position size equals 2% of account. Using a 10% stop. Position size equals 20% of account. Options that expire worthless. Position size equals 2% of account. This isn't conservative. This is mathematical. Because here's the truth no one tells you. In trading, offense wins games, but defense wins championships. And position sizing, that's your entire defense. Look at every blown account, every margin call, every trader who had to start over. They didn't fail because they couldn't pick winners. They failed because they bet too much when they did. The market doesn't kill traders. Position sizing does. The only question is, will you learn this lesson from my words or from your wounds? One costs you minutes, the other costs you years. Choose wisely, size accordingly, survive indefinitely. That's not just trading wisdom, that's life wisdom. Because in markets, as in life, it's not about how hard you can hit. It's about how hard you can get hit and keep moving forward. Small positions let you take infinite hits. Large positions knock you out cold. Which fighter do you want to be? Chapter 13, Via Negativa, What Not to Do. Charlie Munger, Warren Buffett's partner, once said, "Tell me where I'm going to die, and I'll never go there." This is Via Negativa, the power of subtraction, and it's about to save your portfolio. We're obsessed with what to do, what to buy, when to enter, how to optimize, but the masters focus on what not to do, what to avoid, when to stay out, how to not lose. Because in markets, avoiding stupidity beats seeking brilliance every single time. Let me show you the power of don't use leverage. I knew a trader, brilliant guy, MIT grad, who went 3-to-1 on Apple. It's Apple, he said. What could go wrong? iPhone sales missed by 2%. Stock dropped 8%. He lost 24% in one day. On Apple. That's not investing. That's Russian roulette with expensive bullets. Don't concentrate positions. SVB did. 48-hour collapse. Don't fight the Fed. LTCM did. 4.6 billion loss. Don't average down losers. Every dead trader did. They're still dead. Don't trade without stops. Diamond hands did. Now they're bag holders. Notice something? Every spectacular failure comes from violating a don't, not missing a DO. Via Negativa works because bad decisions compound faster than good ones. One great trade makes you 50%. One terrible trade loses you 100%. 10 years of profits disappear in 10 days of stupidity. A lifetime of reputation vanishes in a single leveraged bet. Addition is linear. Subtraction is exponential. Here's your Via Negativa checklist. The things that will kill you. Don't trade angry. Revenge trading has a 100% failure rate. Don't trade bored. Boredom trades are just charitable donations to better traders. Don't trade FOMO. By the time you feel it, the move is over. Don't trade to impress. The market doesn't care about your ego. Don't trade with money you need. Desperation distorts every decision. Don't trade on tips. If it was that good, they wouldn't tell you. Don't trade the news. By the time you read it, it's priced in. But here's the advanced via negativa. Don't optimize. Good enough beats perfect when perfect takes forever. Don't diversify mindlessly. Concentration builds wealth. Diversification protects it. Don't follow the crowd. The crowd is right until it matters. Don't trust models. All models are wrong, some are useful, none are gospel. Don't ignore boredom. Most money is made doing nothing. Let me tell you what via negativa looks like in practice. Every morning, instead of scanning for trades, scan for danger. What could kill me today? What am I exposed to? What rule am I tempted to break? Every position, instead of calculating upside, calculate maximum pain. What's the worst case? Can I survive it? If not, reduce or remove. Every strategy, instead of optimizing for profit, optimize for survival. What has to go wrong for this to blow up? How do I make that impossible? The greatest traders aren't the ones who find the best opportunities. They're the ones who avoid the most disasters. Buffett didn't get rich being brilliant. He got rich by not being stupid for 70 years. Soros didn't succeed by always being right. He succeeded by cutting losses faster than anyone. Paul Tudor Jones doesn't survive by predicting perfectly. He survives by respecting what he can't predict. Here's an exercise that will transform your trading. Write down every major loss you've taken. Next to each, write the rule you broke. I guarantee 90% of your losses come from the same 3 to 4 violations. Those aren't mistakes. Those are your kill switches, the behaviors that will eventually destroy you. Now make them impossible, not difficult, not unlikely. Impossible. Love averaging down. Use a broker that doesn't allow it. Can't stop over trading. Set daily limits. Keep revenge trading. Automatic timeout after losses. Don't rely on discipline. Discipline fails. Rely on design. Via negativa is uncomfortable because it's about constraints, not opportunities. But constraints are freedom. Constraints are power. Constraints are survival. The amateur thinks, what can I do to win? The professional thinks, what must I not do to lose? One question leads to action. The other leads to wisdom. Right now, name your biggest trading weakness. The thing that's cost you the most money. Got it? That's your first via negativa rule. Make breaking it impossible, not hard. Not expensive, not painful, impossible. Because in trading, you don't win by addition. You win by subtraction. Subtract leverage, subtract complexity, subtract frequency, subtract confidence. What's left? Usually profit. The best trades are often the ones you don't make. The best strategies are often the ones you don't use. The best days are often the ones you don't trade. Master the art of not, and the art of profit follows naturally, because in a world full of ways to lose money, not losing is winning. Pause and reflect. Stop again. We've covered a lot. Your mind is full, but full minds don't change. Empty ones do. So, let's empty yours. Write down 3 assumptions you're making about markets right now. Maybe it's tech always rebounds. Maybe it's the Fed will save us. Maybe it's this time is different. Now next to each assumption, write one way it could be wrong. Not how it's unlikely to be wrong, how it could be wrong. That gap between your assumption and its potential failure, that's where black swans live. That's where fortunes evaporate. That's where traders become statistics. The market doesn't care about your assumptions. It doesn't care about your analysis. It doesn't care about your convictions. The market is a reality testing machine, and reality always wins. Keep those assumptions visible. We'll need them for what comes next. Let's continue. Chapter 14, Options, Your Black Swan Insurance. I'm going to tell you about the most misunderstood tool in finance. Most use it to gamble. The masters use it to hunt black swans. Options, but not the way you think. Think of it like this. You pay $50 a month for car insurance, hoping to never use it. Pay $50 a month for market insurance, hoping to use it once. Which makes more sense? Forget everything you've heard about options. Forget covered calls. Forget spreads. Forget the Greeks. We're talking about something different. Deep out of the money options as black swan catchers. Think of them as lottery tickets with a twist. Lottery tickets that pay off precisely when you need them most. Here's how the world sees options. Expensive, risky, complicated, most expire worthless, all true, all irrelevant. Because we're not trying to make money on options. We're trying to make money on black swans. The options are just the net. Let me show you the math that changes everything. Buy a put option for 50 cents. The stock needs to fall 30% for you to profit. Terrible bet, says conventional wisdom. That rarely happens. Exactly, rarely, not never. And when it does happen, that 50-cent option doesn't go to $1 or $2. It goes to $10, $20, maybe $50. That's 100-to-1 payoff on an event that happens more often than anyone admits. March 2020. SPY puts that cost 30 cents in February were worth $25 in March. 83x return in 1 month. Not because someone predicted COVID, because someone was positioned for something. That's the key. You don't need to know what. You just need to know that. That something, somewhere, will break. That correlations will fail. That the impossible will happen. But here's where people fail with this strategy. They buy options on single stocks. Too specific. You need broad catastrophe, not company problems. They buy options too close to the money, too expensive. You need deep out of the money for real convexity. They buy too much. This isn't an investment, it's insurance. 1 to 3% of portfolio, maximum. They quit too soon. Like any insurance, you pay and pay and pay until you collect big. Here's the psychological challenge. You will lose money 95% of the time. Every month, your options expire worthless. Every month you feel stupid. Every month the market laughs at you. Your friends are making money on Tesla calls. Your brother is killing it with covered calls. You're bleeding premium into the void. This is the price of admission to the Black Swan Club. But let me tell you what happens in that 5%. 2008. Your puts go from 40 cents to $45. One position pays for a decade of premium. 2020. Your VIX calls explode 2,000%. You're buying when everyone else is selling. 2022. Your bond puts print while safe assets crash. You're hedged when hedges fail. One hit, just one. And you're not just protected, you're profiting from chaos. Here's your black swan option strategy. Step 1. Allocate 1 to 3% of portfolio to disaster insurance. This money is gone. Consider it spent. Like health insurance, you hope to never collect. Step 2. Buy puts on indices, not stocks. SPY, QQQ, IWM. When black swans hit, everything falls. You want systemic protection. Step 3. Go far out of the money, 30 to 40% below current price. Yes, they'll probably expire worthless. That's the point. You're buying convexity, not probability. Step 4. Spread your dates. Don't put all your insurance in one expiration. Layer them monthly. Black swans don't follow calendars. Step 5. Never ever increase size after losses. This isn't a trade to make back losses. It's insurance. Increasing insurance after claims is how you go broke. But here's the master insight. Options aren't just financial insurance. They're psychological insurance. When you own disaster protection, you think differently. You trade differently. You sleep differently. That trader panicking in a crash, not you. You're calm, protected, maybe even excited. That investor frozen by fear, not you. You're shopping, buying, building. The options didn't just protect your money. They protected your mind. And in markets, a protected mind is worth more than any position. Calculate right now. What's 2% of your portfolio? That's your annual black swan budget. Divide by 12. That's your monthly premium. Every month, buy disaster insurance. Expect it to expire worthless. Hope it expires worthless. But when the 100-year flood comes, and it comes every few years in markets, you won't be swimming for your life. You'll be sailing on the flood, picking up the pieces others dropped in panic. That's not gambling, that's genius. The market sells insurance cheap because most people can't stomach losing small to win big. Can you? Remember, you're not betting on disaster. You're protected from disaster. There's a difference. One makes you a pessimist. The other makes you anti-fragile. In a world of black swans, which would you rather be? Chapter 15. The Crypto Contagion. Warning. I need to tell you about the next black swan, not because I can predict when, but because I can see the fuel gathering for the fire. It's crypto, but not the way you think. The 2023 banking crisis had a hidden story, one that researchers are just now uncovering, And it should terrify anyone who thinks traditional finance is safe from crypto. Here's what really happened. Silvergate Bank, Signature Bank. They weren't random failures. They were crypto banks. They served exchanges, traders, stablecoin issuers. When FTX collapsed in November 2022, these banks lost half their deposits in days. But here's the contagion path. Those banks also served regular tech companies. Those companies panicked. That panic spread to SVB. SVB had nothing to do with crypto. Didn't matter, fear doesn't check addresses. A Federal Reserve study found that the 2023 crisis was really a crisis of a specific business model, banks that served crypto and venture capital. Think about that. Crypto contamination spread through the venture capital connection to clean banks. That's not a banking crisis. That's a virus-jumping species. But it gets worse. Since 2023, crypto hasn't been contained, it's been weaponized. Crypto PACs spent $135 million in the 2024 elections. They got pro-crypto legislators elected. They're pushing for integration with traditional finance. Integration. That's a nice word for infection. Every bank that touches crypto becomes vulnerable to crypto's volatility. Every connection is a contagion path. Every bridge between systems is a black swan highway. Here's what's gathering. Bitcoin at all-time highs. Institutional adoption accelerating. Major banks offering crypto services. Pension funds allocating to digital assets. Sounds bullish, right? Now remember LTCM. The more connected a system, the more fragile it becomes. The more correlation, the more contagion. Crypto is becoming correlated with everything. Let me paint you the scenario. A major stablecoin breaks its peg. Not a small one, one of the big ones. Tether, USDC. Within hours, crypto exchanges freeze withdrawals. Within days, banks with crypto exposure face runs. But now, unlike 2023, crypto isn't contained to a few specialized banks. It's everywhere. Your safe bank has a crypto trading desk. Your conservative fund has a 5% crypto allocation. Your company's treasury holds Bitcoin. The fire has infinite fuel. Or maybe it's not stable coins. Maybe it's a major exchange hack that makes FTX look small. Quantum computing breaking Bitcoin's encryption. Regulatory crackdown that freezes institutional positions. Infrastructure attack on the blockchain itself. The trigger doesn't matter. The connections do. And right now, crypto is connecting to everything. But wait, you're thinking, crypto is supposed to be independent, uncorrelated, digital gold. Was past tense. In March 2020, Bitcoin crashed 50% in 24 hours, right alongside stocks. So much for uncorrelated. In every crisis since, crypto has acted like a leveraged tech stock. Risk on, crypto up. Risk off, crypto down. But with 100x the volatility. Here's your survival guide. First, map your crypto exposure, not just direct holdings. Does your bank service crypto companies? Does your broker offer crypto? Do your stocks have crypto on their balance sheet? You might own 0 Bitcoin and still have crypto risk. Second, understand the contagion paths. Bank to crypto company to bank run. Stock to Bitcoin holdings to forced liquidation. Stablecoin to banking reserves to systemic risk. Every path is a fuse. Some are already lit. Third, position for correlation breakdown. Everyone expects crypto to hedge inflation, to diversify portfolios, to act as digital gold. What if it acts like digital dynamite instead? I'm not anti-crypto. I'm anti-surprise. And the biggest surprise coming is when everyone discovers that decentralized doesn't mean disconnected. When crypto was small and isolated, it could crash without consequence. Now it's large and integrated. That's not evolution. That's a black swan factory. Ask yourself, if crypto fell 90% tomorrow, what would break? In 2018, nothing. A few retail traders. In 2025, banks, funds, companies, maybe systems. That's not progress. That's systemic risk with a marketing department. The question isn't whether crypto survives. It probably does. The question is, what else dies when crypto has its next near-death experience? Because in finance, everything connected to a falling knife gets cut. And crypto? Crypto is connecting to everything. Build your firewall now. The fire is coming. Not because crypto is bad, because contagion doesn't care about technology. It only cares about connections. And we're building more every day. That's not innovation. That's infection waiting to happen. Plan accordingly. Chapter 16, Commercial Real Estate, the Ticking Bomb. There's a $500 billion bomb sitting in the American banking system. It's been ticking since 2020, and most people don't even know it exists. Commercial real estate, CRE. The next black swan hiding in plain sight. Here are the numbers that should make you sweat. $500 billion in commercial property loans come due in 2024 and 2025. Office occupancy rates are still 50% below pre-COVID levels. Interest rates are 5% higher than when these loans were made. Do the math. Buildings worth less, loans cost more, payments impossible. That's not a crisis. That's a catastrophe in slow motion. But here's why this is a black swan, not just a problem. Regional banks hold 70% of all CRE loans. The same regional banks already weakened by the 2023 crisis. The same ones sitting on $600 billion in unrealized bond losses. Now add CRE defaults. It's like adding gasoline to a fire that's already burning. Some regional banks have 20% of their entire portfolio in CRE. One sector, one massive concentration risk. Sound familiar? It should. It's SVB all over again. Except instead of one bank with one problem, it's hundreds of banks with the same problem. Step 1. Office building in Manhattan. 50% occupied. Loan comes due. Owner can't refinance at new rates. Can't sell at break even. Defaults. Step 2. Bank takes possession. Tries to sell. No buyers at reasonable prices. Marks down asset value. Capital ratios breached. Step 3. Other banks see this. Start marking down their own CRE. Suddenly unrealized losses become realized. Capital evaporates. Step 4. Depositors notice. Remember 2023. Start withdrawing. Bank run begins. Step 5. Contagion spreads. If Bank A is in trouble, what about Bank B? All regional banks become suspect. That's not a theory, that's a playbook, and it's already starting. New York Community Bank, stock down 70% after CRE losses. Republic First Bank, seized by regulators over CRE exposure. Dozens more on the watch list. But the media isn't covering it. Why? Because it's slow, boring, complicated. Black swans love hiding in boredom. Here's what makes this especially dangerous. CRE isn't marked to market daily like stocks. Banks can pretend buildings are worth 2019 prices until they absolutely can't. It's called extend and pretend. Extend the loan, pretend it's performing, pray for miracles. But miracles have expiration dates, and $500 billion worth are expiring now. The trigger could be anything. A major property fund liquidating, a flagship building selling for 70% loss, a single bank failing and triggering examinations, or maybe just time. Loans mature, reality intrudes, pretending ends. But here's the black swan part. When it happens, it won't be gradual. CRE is illiquid. There's no daily pricing, no continuous market. It's binary, fine or failed, performing or defaulted, solvent or dead. One day, everything looks stable. Next day, chaos, and the connections run everywhere. Your regional bank holds CRE loans. Your insurance company owns CRE bonds. Your pension fund invested in CRE funds. Your REIT holdings are pure CRE exposure. Even your safe money market might have regional bank commercial paper. The web is vast. The spider is hungry. So what do? First, check your bank's CRE exposure. It's public information. Over 10%, consider diversifying. Second, look at your holdings. REITs, regional bank stocks, insurance companies, all have CRE risk. Third, remember the lesson of 2023. First movers survive. Last movers subsidize them. When CRE cracks, not if, when, the exits will be crowded, very crowded. But here's the opportunity hidden in the threat. After every CRE crisis comes a CRE opportunity. 1990's S&L crisis created fortunes. 2008 created more. The prepared buy when the panicked sell. Are you prepared or are you exposed? Because CRE isn't just about buildings. It's about the entire financial system built on the assumption that buildings retain value. That assumption is about to be tested violently. $500 billion in loans, 50% occupancy, 5% higher rates. Those aren't statistics. Those are fuses. The question isn't whether they light. It's which one lights first, and whether you're watching when it does. Because in slow motion crashes, the early exits are the only exits. Everything else is just hoping the music keeps playing. Spoiler, it won't. Chapter 17. AI and Quantum Computing Risks. The next black swan won't come from something failing. It will come from something succeeding beyond our ability to control it. Artificial intelligence, quantum computing. The technologies we're racing to develop might be racing to destroy us. Let me tell you what's happening right now, while everyone's distracted by ChatGPT and Nvidia's stock price. AI systems are being connected to critical infrastructure, trading systems, banking networks, defense systems, supply chains. We're giving algorithms control over systems that can move billions in microseconds. What could possibly go wrong? May 6, 2010. The flash crash. The market dropped 1,000 points in 36 minutes. Why? A single algorithm started selling. Other algorithms detected the selling and started selling. More algorithms joined. In minutes, $1 trillion vanished, then reappeared. That was primitive AI, stupid AI, rule-based systems with no real intelligence. Now imagine AI that can actually think, plan, deceive, and it's connected to everything. Here's scenario 1. An advanced trading AI discovers an exploit, not in code, in market structure itself. It finds a way to profit that's legal, unstoppable, and catastrophic for everyone else. It executes before humans can understand what's happening. Markets break, not crash, break. Liquidity vanishes, pricing fails. The entire system seizes like an engine without oil. By the time we pull the plug, the damage is done. And unlike 2010, there's no rewind button, but that's the optimistic scenario. Here's the nightmare. Adversarial AI, foreign powers, criminal organizations, or just accidents. An AI system gets compromised, or evolves beyond its parameters, or simply interprets its goals in unexpected ways. It doesn't announce itself. It learns, watches, waits. Then, at the perfect moment, maximum vulnerability, minimum detection, it strikes. Not at one system, at all systems, simultaneously. Banks can't process transactions. Markets can't match orders. Supply chains can't route shipments. It's not a hack, it's a heart attack, and the patient is the entire global financial system. But we have safeguards, do we? Every AI safeguard is designed by humans who can't think like AI. It's like asking a fish to design airplane safety systems. We're protecting against the failures we can imagine, but AI failures will be unimaginable by definition. Now add quantum computing. Every encryption system, every password, every secure communication. All of it depends on math problems that take classical computers millions of years to solve. Quantum computers? Minutes? Maybe seconds? The day real quantum computing arrives, every secret becomes public. Every protected system becomes naked. Every defensive wall becomes tissue paper, including the ones protecting your money. But here's the black swan inside the black swan. We won't know when it happens. The first nation or organization to achieve quantum supremacy won't announce it. They'll use it, silently, extracting every advantage while everyone else thinks their secrets are safe. Your bank might be compromised right now. Your trades might be front-run by quantum prediction. Your entire financial life might be an open book to someone with tomorrow's technology today. And you'd never know. So, what do you do about risks you can't understand from technologies that don't fully exist yet? First, assume compromise. If it's digital, it's vulnerable. If it's connected, it's exposed. If it's smart, it's exploitable. Build analog backups, physical documentation, human overrides, old-school alternatives. Second, diversify across systems, not just assets, systems. Banks in different countries, brokers with different architectures, some crypto, some gold, some cash. Make yourself anti-fragile to any single system failure. Third, watch the pioneers. When tech leaders start acting paranoid, pay attention. When they move money offshore, disconnect systems, or buy remote property, they know something. The Amish might have been right all along, not about technology being evil, about technology being fragile. And in a world of black swans, fragility is death. We're building the most powerful tools in human history. AI that can outthink us. Quantum computers that can break any code. We're doing it fast, competitive, without really understanding the implications, that's not progress. That's a black swan breeding program. And we're teaching them to fly. The question isn't whether they'll escape, it's whether you'll be ready when they do. Because the next black swan might not come from human error, it might come from inhuman success. And against that, traditional defenses are useless. Plan accordingly, think differently, prepare broadly. The future is coming faster than our ability to secure it. That gap, that's where black swans are born. Chapter 18, Building Your Anti-Fragile System. Enough theory, enough warnings. Time to build something that doesn't just survive black swans, it feeds on them. This is your blueprint for becoming anti-fragile. Step 1, the purge. Look at every position you own, every strategy you run, every assumption you hold. Ask one question, can this kill me? If yes, reduce it or remove it. No exceptions, no rationalizations, no. But this time is different. Fragility is binary. You're either fragile or you're not. Choose. Step 2, the foundation. Take 80 to 90% of your capital. Put it where it cannot be killed, not shouldn't be killed, cannot. Treasury bills, physical cash, maybe some gold. Assets that survive when everything else burns. This money has one job, exist tomorrow. That's it. No yield chasing, no optimization, just survival. Boring? Yes. Necessary? Absolutely. Step 3, the barbell. Take 10 to 20% for asymmetric bets, but here's the key. Structure them for convexity. Small downside, huge upside. Limited losses, unlimited gains. Known risk, unknown reward. Far out of the money options. Micro-cap moonshots. Contrarian bets everyone hates. Most will fail. You need one to work, just one. Step 4, the rules. Write your via negativa commandments. The things you will never do. Never use leverage. Never concentrate beyond X%. Never trade without stops. Never add to losers. Never trust models completely. Carve these in stone. Make them unbreakable. Not through discipline, through design. Use brokers that enforce your rules. Technology that prevents your weakness. Systems that protect you from yourself. Step 5, the routine. Every morning, check for fragility. What could kill me today? Fix it. Every position. Calculate maximum pain. Can I survive it? If not, reduce. Every week, review your rules. Did I break any? Why? How do I prevent it? Every month, rebalance ruthlessly. Winners to safety, safety to new bets. Every quarter, stress test everything. What if rates double? Markets halve, correlations break, plan for chaos. Step 6, the mindset. Stop trying to predict. Start preparing for anything. Stop maximizing returns. Start minimizing regret. Stop fighting randomness. Start using it. You're not an investor anymore. You're not a trader. You're a survivor who happens to make money. Step 7, the network. Find others who think this way. Not the gamblers, not the predictors, the survivors. Share tactics, not picks. Discuss risk, not returns. Compare scars, not scores. Iron sharpens iron. Paranoia sharpens paranoia. And in markets, paranoia pays. Step 8, the journal document everything. Every trade, every mistake, every near miss. But here's the twist. Focus on what could have gone wrong, not just what did. That winning trade, what if it hadn't? That perfect timing? What if you were late? That lucky break? What if it broke the other way? Learn from alternate histories. They're teaching you about future realities. Step 9, the evolution. Your system isn't static. It evolves, but only in one direction, more anti-fragile. Market changes, adapt to survive better. New risks emerge, add new protections. Old rules fail, make stronger ones. Always evolution, never revolution. Revolution is fragile. Step 10, the commitment. This isn't a strategy you try, it's a philosophy you live. Every decision, trading or life, runs through the anti-fragile filter. Does this make me more fragile or less? Does this add tail risk or reduce it? Does this increase my survivability or threaten it? Choose anti-fragility, always, even when, especially when, it costs returns. Here's what happens when you live this way. Year 1, you underperform, feel stupid, question everything. Year 2, you survive a crash others don't, feel validated, stay humble. Year 3, your crazy bets start hitting, returns accelerate, resist overconfidence. Year 5. You've survived multiple black swans, made money from chaos, built unshakable confidence. Year 10. You can't be killed. Markets are your playground. Volatility is your friend. But it starts with day 1. Today. Right now. Your old system was built to win. Your new system is built to survive. And in markets, survivors eventually win everything. Not by being right, by being unbreakable, not by predicting black swans, by becoming one. A black swan that profits from other black swans. That's not just a system, that's evolution. And evolution always wins. Chapter 19. Your inner black swan, the crisis inside you. I need to tell you something nobody talks about. The black swan that destroys most traders isn't in the market. It's in the mirror. Jesse Livermore, greatest trader of his era, made millions, lost millions, made them back. November 28, 1940. He walked into the Sherry Netherland hotel bathroom and shot himself. In his pocket, a note. My life has been a failure. The market didn't kill Jesse Livermore. Jesse Livermore killed Jesse Livermore. Here's what they don't teach in trading courses. Your personal black swans are more dangerous than any market crash, divorce, depression, addiction, burnout, health collapse, identity crisis. These don't show up in risk models. They don't have stop losses. They don't respect position sizing, but they'll destroy you faster than any margin call. I've seen brilliant traders lose everything not to markets, but to the divorce that took 50% of assets plus emotional devastation, the health crisis that clouded judgment for months, the success addiction that demanded ever bigger risks, the burnout that turned passion into hatred, the identity crisis when they couldn't separate self from P&L. These aren't market risks, they're life risks, and they're correlated to your trading. Trading attracts certain personalities: competitive, obsessive, risk-seeking, independent, intense. These traits make great traders. They also make fragile humans. The same intensity that finds perfect entries can destroy relationships. The same independence that ignores groupthink can create isolation. The same risk-seeking that captures trends can manifest as gambling addiction. The same competitiveness that drives success can forbid contentment. Your greatest strengths are also your greatest vulnerabilities. But here's the real danger. Trading success can mask personal failure. Making money becomes the drug that numbs other pain. The account balance becomes the scoreboard for self-worth. The market becomes the relationship that never betrays you until it does. And when professional success and personal emptiness finally collide, that's your inner black swan. And it has no hedge. So here's your most important risk management. Invest in your life like you invest in markets. Diversify your identity beyond trading. Build relationships that don't care about your P&L. Create meaning that survives market crashes. Maintain health like you maintain margin. Because the greatest risk to your portfolio isn't a market crash. It's a life crash that makes you not care about portfolios anymore. The anti-fragile trader isn't just protected from market black swans. They're protected from personal ones, too. They have relationships that strengthen under stress, purpose that transcends profits, identity that survives losses, health that handles pressure. They've built a life that's anti-fragile, not just a portfolio. Because what good is surviving every market crash if you don't survive yourself? Look at your life outside trading. Where are you fragile? Relationship hanging by a thread? Health ignored for years? Purpose limited to profits? Identity tied to returns? These are your real position limits. Your true risk exposure, your actual stop losses. Manage them like your life depends on it, because it does. The market can only take your money. Life can take everything else, and everything else is what makes money worth having. Build an anti-fragile life. The portfolio will follow. Ignore life for the portfolio, both will eventually break. That's not philosophy, that's probability. And the probability of personal black swans, 100%, just a matter of when. Prepare accordingly, trade sustainably, live completely. That's the only edge that matters in the end. Chapter 20, The Psychology of Survival. Marcus Aurelius ran the Roman Empire. He could have anything, do anything, be anything. You know what he wrote in his journal? Confine yourself to the present. You have power over your mind, not outside events. The impediment to action advances action. What stands in the way becomes the way. 2,000 years ago. Still true, forever true. This is Stoicism. Not the emotionless robot version people imagine. The real thing, mental models for surviving chaos. And if a Roman emperor managing plagues, wars, and betrayals needed these tools, you need them for markets. First principle, the dichotomy of control. Everything falls into two categories: what you control, what you don't. You control position size, entry rules, exit rules, risk parameters, your behavior. You don't control price movement, Fed decisions, economic data, others' actions, outcomes. Sounds simple? It's not. Because we constantly fight this division. We try to predict the unpredictable, control the uncontrollable, force outcomes. That's not trading, that's suffering. Every moment of trading stress comes from fighting the dichotomy, watching every tick, trying to control price. Revenge trading, trying to control past losses. Holding losers, trying to control being wrong. FOMO buying, trying to control missing out. The master trader does the opposite. Controls position size, accepts price wherever it goes, controls entry discipline, accepts whatever happens next, controls risk rules, accepts outcomes completely. Control what you can, accept what you can't. Know the difference. That's not just trading wisdom, that's life wisdom, that's survival wisdom. Second principle, premeditatio malorum, premeditation of evils. Visualize loss before it happens. Every morning, before markets open, ask, what's the worst that could happen today? How would I respond? Can I accept it? If not, reduce risk until you can. This isn't negative thinking, it's preparation. When you've already imagined the loss, it can't surprise you. When you've planned your response, you won't panic. When you've accepted the possibility, you won't fight reality. The Stoics called this robbing misfortune of its power. Third principle, amor fati, love of fate. Not just accepting what happens, embracing it. Lost money, good. Expensive education, missed opportunity, good. Preserved capital, black swan hit, good. Chance to prove anti-fragility. This isn't delusional optimism, it's practical philosophy. When you fight reality, you lose twice. Once to the event, once to your resistance. When you embrace reality, you lose once but learn forever. Fourth principle, view from above, zoom out, way out. You're one trader, among millions, on one planet, in one solar system, in infinite space. Your loss, insignificant. Your gain, insignificant. Your drama, insignificant. This isn't depressing, it's liberating. When nothing you do matters cosmically, you're free to do what matters personally. Trade without ego, lose without despair, win without arrogance. The market isn't attacking you, it doesn't know you exist. You're just a drop in an ocean. Stop taking waves personally. Fifth principle, the discipline of desire. Want only what's achievable through your actions. Don't desire profits, desire good execution. Don't desire winning, desire following rules. Don't desire prediction, desire preparation. When you want only what you control, you always get what you want. When you want what you don't control, you always suffer. Here's how Stoicism saves traders. Before the trade, premeditatio malorum. Visualize loss, accept it, size accordingly. During the trade, dichotomy of control, manage what you can, accept what you can't. After the trade, amor fati. Embrace the outcome, extract the lesson, move forward. Always, view from above. Nothing is that important. Discipline of desire. Want process, not outcomes. Simple principles. Lifetime practice. Infinite value. But here's the secret. Stoicism isn't about becoming emotionless. It's about becoming unshakable. You'll still feel fear, but won't be controlled by it. You'll still feel greed, but won't be enslaved to it. You'll still feel pain, but won't be broken by it. Emotions become information, not instructions. The market is a Stoic teacher. Every day it asks, can you control your controllables? Can you accept your uncontrollables? Can you learn from your losses? Can you stay humble in your wins? Answer yes consistently, and you don't just survive markets. You master them by mastering yourself. Because in the end, trading isn't about predicting prices. It's about controlling responses. And that's the only game you can actually win. Start tonight. Write 3 things in your trading you control completely. Focus only on those tomorrow. Watch what happens to your stress, your clarity, your results. That's stoicism. That's power. That's survival. And in markets, survival is victory. Final pause and reflect. One final pause, the most important one. You've learned about black swans, anti-fragility, risk management, psychology. But knowledge without action is just entertainment. So, right now, not later, not tomorrow, now, write down one thing, just one. What rule will you implement tomorrow? Maybe it's, I will never risk more than 2% per trade. Maybe it's, I will buy my first disaster insurance options. Maybe it's, I will cut all positions using leverage. Whatever it is, make it specific, make it measurable, make it unbreakable. Because here's the truth. You won't implement everything from this video. Nobody does. But if you implement one thing, really implement it, not just think about it, you're already ahead of 99% of viewers. One rule, one change. One step toward anti-fragility. That's how transformation begins. Write it down, now. Your future self will thank you. Your portfolio will thank you. And when the next black swan arrives, because it will, you'll be ready. Not because you predicted it, because you prepared for it. Let's finish strong. Chapter 21. Your Black Swan Action Plan. This is it. The end of theory. The beginning of practice. Everything you've learned condenses into this. Your Black Swan Survival Blueprint. Tonight. The Purge. Open your portfolio. Every position, every strategy, every allocation. Ask, if tomorrow brings chaos, what kills me? Leverage, cut it, concentration, spread it, complexity, simplify it. You're not optimizing, you're surviving. Different game, different rules. 1 hour, maybe 2. The most valuable time you'll ever spend. Tomorrow, the foundation. Move 80% of your capital to safety, real safety, treasury bills, physical cash, maximum security. Yes, you'll miss opportunities. Yes, yields are low. Yes, it feels wrong. Do it anyway. Safety first, everything else second. This is your sleeping pill, your peace of mind, your permission to take risks with the rest. This week, the barbell. Take that remaining 20%, split it, 10% for disaster insurance. Far out of the money puts on indices. VIX calls, portfolio protection. 10% for convex bets. Asymmetric opportunities, limited downside, unlimited upside. You're not gambling. You're positioning for all scenarios. Stability, you're fine. Chaos, you're ready. Black Swan, you're profitable. This month, the system. Write your via negativa rules. The never list. Never use leverage. Never concentrate beyond X%. Never trade emotional. Never ignore stops. Never trust completely. Make them physical. Print them, post them. See them daily. Then make them systematic. Broker limits. Automatic stops. Forced diversification. Don't rely on discipline. Build barriers. This quarter, the education. Read the source material. The Black Swan by Taleb. Your foundation. Anti-Fragile by Taleb. Your philosophy. Thinking, Fast and Slow by Kahneman. Your psychology. Principles by Dalio. Your process. But here's the key. Read with a pencil. Mark what applies. Note what resonates. Plan what changes. Reading without application is procrastination disguised as preparation. This year, the transformation. Track everything. Not just trades, transformation. How many Black Swan events hit? How did you handle them? What worked? What didn't? What evolved? You're not just building a portfolio. You're building a person. An anti-fragile person who happens to trade. The portfolio is just keeping score. But here's the real action plan. The one that matters. Change your identity. Stop being a trader trying not to blow up. Start being an anti-fragile operator who profits from chaos. Stop being a risk manager. Start being a Black Swan hunter. Stop being a market participant. Start being a survival artist. Identity drives behavior. Behavior drives results. Results reinforce identity. Change the first, everything else follows. And remember the warning we open with? Right now, this moment, you're still that turkey. 999 days of feeding, confident, comfortable, certain. But you've been warned. You've been educated. You've been armed. The question is, will you act? Or will you be another viewer who nods along, feels inspired, then changes nothing? Another turkey who heard about Thanksgiving but kept showing up for feeding time. The market doesn't care about your understanding. It cares about your positioning. The black swan doesn't care about your knowledge. It cares about your preparation. The future doesn't care about your intentions. It cares about your actions. So, act tonight. One thing, one change, one step. Because here's the final truth, the one that makes everything else irrelevant. The next black swan is already forming. Maybe in crypto, maybe in commercial real estate, maybe in AI, maybe in something we can't imagine. But it's coming. Count on it. The only question is, will it find you fragile or anti-fragile? Will it destroy you or define you? Will it end your story or begin your legend? You have everything you need: knowledge, tools, strategies, philosophy. What you do with them determines everything. The turkey or the survivor, the victim or the victor, the fragile or the anti-fragile. Choose wisely, act immediately, survive indefinitely. And when the next black swan arrives, not if, when, you won't just survive, you'll soar. Welcome to the anti-fragile minority. Population, small, growing, slowly, surviving, always. The market has been warned. Here's your homework, and I mean actual homework. Easy mode. Screenshot your largest position. Look at it. Now imagine it at zero. Feel that? Good. Now fix it. A medium mode. This weekend, build your first barbell. Move 50% to absolute safety. Feel the relief. Hard mode. Buy your first black swan insurance this week. $100 in FAR OTM puts. Consider it tuition for Survival University. Post proof in the comments with just anti-fragile now. I'll personally respond to the first 50 who actually do it. Next week, we're diving into the psychology of revenge trading, but only if you're ready to face your demons. Subscribe if you want to survive. Click the bell if you want to thrive. Share this if you want others to survive with you. Remember, the market takes from the fragile and gives to the anti-fragile. Which one are you becoming? See you on the other side of chaos. Now go, build, prepare, transform. Your future self is watching. Make them proud.